amendment whereby the definition becomes or includes the distribution of software and where regular payments are made to the distributor in the ambit of the definition of royalties. So this means that payments for the distribution of software will be subject to withholding tax as a royalty, which again comes against the ruling that was issued in 2023 on a very famous case on 7Cs, that where the High Court noted that payments for distribution of software do not give a right to use the software and should not be deemed to be royalties. But again, that if these are sentenced into law, that will become effective from 1st of July 2025. Another change that has come in comes through a new tax that was introduced through the Tax Laws Amendment Act called the Significant Economic Presence Tax that came in to replace the Digital Service Tax. And Significant Economic Presence Tax is really a tax that covers any form of transactions by a non-resident person taken through a digital marketplace. And what the finance bill wants to do is that it wants to increase the coverage of that tax to cover also transactions undertaken either through the internet or through an electronic platform, to be inclusive of or to be within the scope of significant economic presence tax. Significant economic presence tax, if you remember, is at the rate of 3% of the turnover of the non-resident person on any income that is derived or accrued from Kenya. And there was an exemption for persons whose turnover was less than 5 million shillings. And Finance Bill 2025 again wants to do away with that exemption. So any non-resident person undertaking a business in Kenya through an electronic platform or through the internet or through a digital marketplace will be liable to pay digital service tax at the rate of 3%, irrespective of the year turnover. A very welcome proposal that we have seen in Finance Bill 2025, whereby there is the proposed introduction of what we call advanced pricing agreements. And advanced pricing agreements for those taxpayers who have related party transactions with non-resident persons simply mean that you can prepare your transfer pricing documentation beforehand, go with it to the Kenya Revenue Authority, agree on the methodology that you have selected and how you are going to be pricing your transactions. And when the KRA is amenable to how you have carried out your transfer pricing documentation, you enter into an agreement, and that agreement will be valid for a period of 5 years, whereby the KRA cannot rescind on how they have agreed that transaction to be undertaken. They can only come to check if that transaction is being undertaken as per the agreement. So this is a very welcome proposal if assented into law, which will become effective from 1st of January 2026, because it will offer a lot of certainty in terms of transfer pricing documentation and persons with related party transactions, because you'll be knowing that within the next 5 years, the KRA are agreeable to how you're undertaking your transaction. Of course, this comes or calls for guidelines that will govern how those discussions with the KRA will be undertaken. And on top of that, the KRA can be able to nullify that advanced pricing arrangement whereby they deem there was misrepresentation by the taxpayer in terms of the material information at the time of entering into that agreement. Again, another change that comes to persons with related party transactions, or a change that affects transfer pricing dealings, is that again, through the Tax Laws Amendment Act 2024, there was the introduction of the minimum top-up tax on multinational enterprises that are tax resident in Kenya and that are part of a group whose annual or consolidated turnover is more than 750 million euros or USD thereof. Now, a minimum top-up tax is supposed to, in simple words, provide that if you are a multinational enterprise or a constituent entity of a multinational enterprise operating in Kenya, and your effective tax rate is less than 15% on income taxes, you are supposed to uplift that tax to at least 15%. So it provides that there needs to be a minimum tax, and if you don't meet that minimum tax, you top it up to that 15%. There was ambiguity in terms of when is the tax due, and the Finance Bill 2025 has come to provide clarity that that tax will be due by the end of the fourth month after year end, or simply will be payable together with what we call the balance of tax. There is a proposal on capital gains tax exemption, just a small proposal whereby currently, if you do a transfer of property to a company that is owned 100% by spouses or immediate family members, there is a capital gains exemption. The bill tries to open that up a bit and provide that that exemption is also inclusive where you transfer the property to a company that is owned 100% by an individual spouse. As current is, the company has to be owned by the spouses, not by an individual spouse. So it is just a way of ensuring that succession planning becomes easier and is exempt from capital gains tax. There is a slight clarification on withholding tax on qualifying dividends and qualifying interest, and the Act has made it very clear that qualifying dividend, withholding tax on qualifying dividends and qualifying interest is a final tax. I think this is just a clarity because the same had always been in place. There is also a reduction, a proposed reduction on digital service, digital assets tax. Digital asset tax was introduced by the Finance Act 2023, and it covers any digital transactions or transactions video items like cryptocurrency that are being accrued or derived from Kenya. The rate was at 3%, and there is a proposal to reduce that rate to about 1.5%, possibly as an incentive to encourage persons who are undertaking any transactions involving digital assets to be remitting the tax at the rate of 1.5%. Another clarification that has come in on capital gains tax is that the Act has clarified that, and the bill seeks to clarify that membership clubs and trade associations will be liable to capital gains tax on any qualifying transactions for transfer of property in Kenya. Something else that is proposed on the Finance Bill 2025, is on the diminution allowance. This was there again in Finance Bill 2024. It has been reintroduced again, whereby the bill proposes to provide that diminution allowance on loose tools that are incurred, or the expenditure on loose tools incurred by companies will be allowable at the rate of 100%, or simply to be expensed fully in the year that it has been incurred. Something to do with donations towards construction of public sport facilities. The government wants to invite taxpayers to invest in construction of public sport facilities. So if you make a donation towards the construction of public sport facilities, that deduction will be tax deductible. Again, as you'll see in the subsequent slides, there is a proposal to repeal the current exemption that provides that any sponsorship to sport activities are tax deductible. I think the most notable thing about the proposed changes to the income tax act, and one that will affect so many taxpayers, is on the issue of the carry forward of tax losses. Currently, if you have any tax losses, you are allowed to carry forward those tax losses for a period of for an indefinite period. The Finance Bill 2025 proposes to cap that period to 5 years. Perhaps, as we mentioned earlier on, is one of the ways that the government is trying to rationalize on tax expenditure and limit the period around which you can carry forward your tax losses. There is some ambiguity in terms of how that proposal is drafted in the bill, because it doesn't provide the effective time when you'll be counting the 5 years, especially for persons who already have tax losses. The last time we saw a capping on the tax losses, the act was very clear that the first year was for any tax losses that you had from prior years became the year the act became into law. So we expect such clarity, and we'll be pushing for that clarity through the public participation process as the bill goes through parliamentary public participation process. Some other changes that are proposed through the Income Tax Act is that for charitable organizations, currently the commissioner has 60 days from the date of application to issue you with an exemption certificate. There is a proposal to increase that timeline from 60 days to 90 days, perhaps giving the commissioner additional time to be able to scrutinize the operations and make an informed decision in terms of issuing a tax exemption certificate. Something else that comes in as a proposal through the Finance Bill 2025 is that where you make an application to the commissioner for a change of year end, you're supposed to make that application 6 months before the change of before the year end is in place. The commissioner, on the other hand, has 6 months to respond to you whether the application is granted or not. The bill proposes that after the lapse of the 6 months after you've made your application and the commissioner has not communicated back, there will be an automatic approval of that application, perhaps providing some certainty in terms of the timeline that you're supposed to keep pushing the commissioner to grant you that response in terms of the change of year end. Another proposal that comes in is that the income of a non-resident ship owner is taxable in Kenya at the rate of 2.5%, and currently that obligation is vested on the ship owner. There is a proposal to change that and vest that tax obligation on the person who has engaged the ship owner through a withholding tax mechanism. So ideally, if this proposal comes into law, if you have engaged a ship owner, the payments that you are going to make to them, you are going to withhold tax at the rate of 2.5%. There is some tax incentives that have been proposed for companies that are certified by the Nairobi International Financial Center Authority. And just to mention is that the Nairobi International Financial Center Authority was created to attract investors to Nairobi being a regional financial hub. And there are some tax incentives that have been proposed to ensure that that comes into fruition, to ensure that companies are able to establish or put their operations under the NIFCA. And this is supposed to maybe attract companies that earlier on were setting up in entities like Mauritius, the BVI, or those tax havens as we know them, and try to provide the same raft of tax incentives that they enjoy out there. So to incentivize entities to set up in the Nairobi International Financial Center Authority, the bill proposes that any dividends that are paid by a company that sets up under NIFCA and has an investment of around 250 million shillings in a year of income will be exempt from tax. The bill also proposes some preferential tax rates on companies that invest in the Nairobi or through the Nairobi International Financial Center Authority at the rate of 15% for the first 10 years and 20% for the next 10 years, more or less trying to mirror it to the SEZ framework. And this comes with conditions that such companies have to invest at least 3 billion shillings in a year of income and have to have at least 70% of their employees being citizens of Kenya. Some other incentives, perhaps targeting startups, is that for startup companies that register with the NIFCA, they will be enjoying a tax rate of 15% for the first 3 years and 20% for the next 4 years, trying to attract startup companies to set up through the Nairobi International Financial Center Authority. In terms of employment taxes, just a few changes that have come in. There is a proposal to increase the tax-free per diem limit from the current 2,000 shillings per day to around 10,000 shillings per day, perhaps taking cognizance of the increased cost of living, and also taking note of the fact that the Tax Laws Amendment Act provided for the persons under the public service are not taxable for their per diems. There is also the proposal to provide that for any mortgage interest, currently mortgage taxpayers enjoy tax exemption on the mortgage interest up to 360,000 shillings per annum, and that is only on amounts borrowed for purchase or renovation of the residential premises, or what we call owner-occupied residential premises. The bill proposes that exemption will also be applicable to persons who also borrow for the purposes of constructing residential premises or owner-occupied residential premises. The other proposal around employment taxes is that through the Tax Laws Amendment Act 2024, there was the pension withdrawals after the attainment of retirement age or due to ill health or after 20 years of contribution are exempt from taxes. This also includes gratuity or other allowances paid under the public pension scheme. And what the Finance Bill 2025 proposes is that both gratuity and other allowances will also be tax exempt, because as currently is through worded in the Income Tax Act, it is either gratuity or other allowances that are exempt from taxes. So we presented into law both gratuity, other allowances, as well as withdrawals from a pension scheme upon attainment of the retirement age or upon reaching 20 years of contribution, on early withdrawals due to ill health will be exempt from taxes. Like we mentioned earlier on, there is a number of repeals, and when we look at these repeals, they are trying more or less to rationalize tax expenditure and ensure that tax expenditure for the government remains at a minimum. Again, some of these repeals come on the backdrop of cleanups due to the many changes that we have experienced in the tax laws in the recent past. So I think the first one we already mentioned about it. The first one is on the employment income of non-citizens, whereby currently non-citizens are exempt on a third of their employment income, provided that they work for an employer who is non-resident in Kenya. That employer is not liable to pay taxes in Kenya, and those non-citizens were in Kenya for a period of less than 120 days in a year of income. So the bill proposes that for such non-citizens who enjoyed a tax exemption of up to a third of their salary will now be taxable on the full salary based on the income that has been accrued or generated from activities or income that has been generated in Kenya. There is some sort of a cleanup in terms of the taxation of membership clubs and trade associations. The Finance Act 2023 provided that all the incomes of membership clubs and trade associations is taxable in Kenya, with the exemption of the subscriptions as well as the members joining fee. So this is just a cleanup to provide that any other income that is derived by a membership club or trade association will be subject to tax in Kenya. Another significant proposal is that we've had for a very long time 100% investment allowance for certain expenditure, notable expenditure by a special economic zone, or where you invest more than 250 million shillings outside the counties of Nairobi and Mombasa. So the Finance Bill 2025 proposes to repeal that 100% investment allowance, so that effectively the applicable investment allowance would be the 50% in the first year and 25% for the next 2 years. So this is one of the ways we are seeing that the government is trying to get tax revenues, perhaps through minimizing some of those tax incentives that have been provided to taxpayers. We'll see again some other tax incentives that are being repealed in the subsequent discussion. Something else that comes in is that where we incur capital loss on disposal of property, especially for capital gains taxes, you are meant to offset that capital loss against any taxes or any income for that year of income. So the bill proposes that any capital loss on disposal of property will not be offset against the income of that year or be carried forward for any subsequent years. Another repeal that comes in is through what we call country by country reporting requirements, whereby if you are within the ambit of what we call country by country reporting requirement for multinational enterprises, simply you are a constituent entity or you are a multinational enterprise operating in Kenya and your turnover is more than 95 billion shilling, then you get into the ambit of country by country reporting requirements. And if you have several entities operating in Kenya, the Act provides that the multinational enterprise shall appoint one of the entities as a surrogate parent entity for purposes of filing the country by country reports. And the bill proposes that there will be no requirement for the appointment of a surrogate parent entity, and inherently, both all the entities that are tax resident in Kenya will be required to file the country by country report in Kenya. Of course, there are the exemptions whereby there is no requirement to file a country by country report if the headquarters of the multinational enterprise is required to file a country by country report and there is a competent authority agreement between that jurisdiction and Kenya. Another repeal that comes in is that for persons who are in the real estate sector and you construct a minimum of 100 units in a year of income, you enjoy a preferential tax of 15% of your income for that year of income. The bill proposes to repeal this and provide that those persons who construct whatever number of units will be liable to tax at the corporate tax rate of 30%. Again, another repeal that comes in on the preferential tax rate is that for persons who are engaged in the assembly of local assembly of motor vehicles upon meeting a certain threshold of local content, they enjoy a tax rate of 15% for the first 5 years, and they are eligible to enjoy another 15% for the next 5 years. So the bill proposes to repeal this and provide that such persons will be liable to tax at the rate of 30%. I think we mentioned the last one about deductibility of expenditure for sports sponsorship activities. It will no longer be tax deductible in a year of income, and will discourage many persons who engage in sports sponsorship activities from engaging in those sponsorship activities. Again, like we noted earlier on, there is a substitute to it that the government wants taxpayers to channel that money towards construction of sports premises or sports stadiums and so forth. So that brings us to an end of the proposed changes through the income tax. As you can see, the government has been very careful this year around, of course, on the backdrop of what happened last year, not to introduce any new taxes from an income tax perspective, but there is a deliberate effort towards rationalizing tax expenditure through minimizing the preferential tax rates that were provided or the tax incentives that have been provided to taxpayers, as well as trying to get taxes through perhaps widening the tax bracket through new industries like the digital marketplace, by capturing all transactions for significant economic presence tax. At this point, I want to invite my colleague Kenneth to take us through the changes through the Tax Procedures Act. Kenneth?
Thank you very much, Kevin, for the introduction, and good morning, everyone, and thank you for joining us on this webinar. Today, I will be taking us through the Tax Procedures Act, and this was actually came to be in the year 2015, and the basis of this act was to harmonize all the procedures when it comes to the administration of tax. And so we've been seeing changes that come in on a year-on-year basis. And the first change I want to cover is the electronic tax invoice exemptions. So as the TPA is currently worded, basically they have expanded the definition. So currently it talks about emoluments, imports, payments of interest, transactions for accounting for investment allowances, and ticketing. And what we see now is that they've actually introduced a new one that talks about payments that are subject to withholding tax, where that withholding tax is final. I think Kevin in his presentation has talked about some of these transactions that withholding tax will be final. So we're talking about qualifying dividends, qualifying interest. Maybe what other examples we can think of are maybe non-residents without a permanent establishment, and for the capital gains tax. So basically, these electronic tax invoice exemptions, they were trying to mirror what has been provided for by the tax procedures, electronic tax invoice regulations that were introduced last year in March. And basically, the wording has just been borrowed so that they sort of align. So maybe the question to us is some of these exemptions, especially the one where payments where withholding tax is a final tax, it may not really be relevant to a lot of businesses, because like in the case of qualifying interest, it is what is paid to an individual. And you'd find that there are very few cases, if it's a payment to a non-resident, it would still be covered under imports. So the regulations are just trying to give some clarity on what transactions will be exempt from the eTIMS invoices, yeah? The next amendment was they were trying to amend Section 31 of the Tax Procedures Act. And this is where the commissioner actually gives you an amended assessment. So currently, as per the Act, the commissioner is only required to provide to you what the principal tax is and what the interest will be on that, the tax itself and the penalties, and how the taxpayer is expected to make a payment for that tax, and if there is any redress in terms of how to object to that assessment. And so, and there's an addition to that, and now what the commissioner will actually be required to do is provide you with a reason for the amended assessment. So should this provision actually go through to become the Finance Act, it will be a welcome move to taxpayers, because now the commissioner will be required to provide the reason for the amended assessment. Another one is a penalty for failure to deduct withholding tax. This is actually a very welcome move and signed as Section 39A of the TPA. And basically what this does is currently what the TPA provides for is that if you fail to make a payment for withholding tax on a qualifying payment, then you as the person making the payment is deemed to be responsible for that tax. And remember that tax is not really yours, you're just an agent and you're withholding it for the actual principal. So what the Finance Bill 2025 proposes to do is actually relieve the taxpayer in the case where the person who you are meant to deduct the payment, if he goes ahead and files the return and accounts for the taxes, then you as the agent who was required to deduct the withholding tax will not be required to intervene. And basically, this is a very welcome move because it was leading to a lot of double taxation, because really I am just an agent, and if the person goes ahead to declare it, then there is really no tax loss from the Kenya Revenue Authority perspective. Yeah, so this is actually a very welcome move. Another change we've seen is when it comes to security on property for unpaid tax. Yeah, so the Tax Procedures Act empowers the commissioner to actually go and grab your assets if they are of the opinion that you are not going to make a tax payment or you have actually failed to make the tax payment. And what the regulations provide is that the commissioner would actually go and speak to the registrar. And by the registrar, it is the person who's in charge of administering that asset. So for example, if it's land, we'll be talking about the registrar of lands. If you're talking about a motor vehicle, we'll be talking about the National Transport and TSA. So basically what this proposal, the finance bill tries to exempt the commissioner from the payment of stamp duty were they to actually attach property where stamp duty is due. So this is just a way to make the commissioner be able to collect security from your property without having to incur stamp duty on such transactions. Another very interesting provision is they have extended agency notices. So currently, the KRA can actually issue an agency notice for somebody who owes you money, deduct and pay it to the Kenya Revenue Authority. So currently, the TPA only provided this for resident companies. And what the finance bill has done is it has expanded this to also cover non-residents. I think in the case Kevin was talking about how there's some new taxes that have come in, for example, the significant economic presence tax. So, and you can see the challenge for the revenue authority is trying to get some of these taxpayers. If you're talking about a non-resident who has not set up here, then it becomes very difficult for the commissioner to be able to collect such taxes. And so with this proposed change, the commissioner is actually empowering himself to be able to go and find people who owe money to these non-residents and channel that money to be for them to be able to cover the taxes that are due to them. Another proposal we saw was the cleanup of the withholding tax, withholding VAT penalty under Section 42. And so what was happened is the Tax Procedures Amendment Act of last year, 2024, it actually brought in a clause that tried to amend the date of payment, and in it, they actually provided for a penalty of 10%. So what happens if you look at the Tax Procedures Act as it is, it provides for a penalty of 10% in two different sections. And basically, this is just a cleanup so that it is very clear that the withholding VAT penalty is going to be 10%. Quickly on, and Section 47, where we have offset or refund of overpaid taxes. And what the Finance Bill 2025 is trying to do is sort of clean up. So what happens is when you have overpaid tax, there are actually two options that you have. You can either apply for a refund or you can apply for an offset of the VAT. And so as the tax is current, as the TPA is currently worded, so it was expanded to show the type of taxes that you could be able to seek a refund or an offset, and it was giving an example of the input VAT, and another example was installment taxes. And I think the issue of input VAT is due to the difficulty of trying to match this invoice with that one person's input is the other person's output. I think it was a very difficult provision to actually apply. And how do you use a tax payment to actually offset input VAT? So it is sort of trying to clean up that provision such that it just talks about installment taxes. And still under the same section, we have seen what the KRA has, what the Finance Bill 2025 does. It is extending the payment of which the commissioner is required to respond to you on whether your refund or your offset has been approved. And so currently the TPA provides for 90 days, and we're seeing that the Finance Bill proposes to extend this from 90 days to 120 days. And if the commissioner actually does an audit to ascertain the validity of the refund, then that timeline actually moves to 120 days. And what happens is the Finance Bill proposes to extend this further from 120 days to 180 days. So it is basically giving the commissioner more time to be able to validate refund or offset applications. Another very interesting is the sharing of trade secrets and customer data under Section 59A of the TPA. And this is actually an amendment that came in last year from the Tax Procedures Amendment Act. And basically, under that amendment, the commissioner was barred from requesting from information that is sensitive, so trade secrets and customer data was not, the taxpayer was not required to integrate with the KRA systems to provide this data. But the finance bill actually seeks to delete this exemption. And what this means is that the commissioner will have powers to access even trade secrets and customer data. And in our opinion, we believe that this is a sort of brings issues, especially when it comes to data privacy. And be it as it is, the commissioner is still empowered to go. So, for example, if the commissioner wanted to access your bank statements, they simply just write to the bank and ask them to provide for that detail. So, some of this information, and we think about this should be financial data that they should actually be accessing. So, our question is why would they need to really access trade secrets and customer data, especially in light of these data privacy rules. So this is actually one of the provisions that we are going to try and fight, because we do not believe how this is going to help the commissioner to collect more taxes, more taxes by being able to access your personal data and trade secrets for the specific companies. Another proposal was late objection to tax decisions. So the finance bill proposes to sort of make it clear that where the commissioner allows a late objection, then on counting the days in which they're required to respond, then the first date is when the objection is actually lodged. So this is just a clarification so that we are not sort of referring to the initial period of 60 days was meant to end. What it actually allows you is they can actually extend it to when they actually approve it, that is when the date will actually start counting. Yeah, so that is actually a welcome move, and it provides clarity when it comes to the commissioner allowing late objections. Another proposal is on the waiver of penalties and interest. So the Finance Bill 2025 actually it empowers the commissioner to waive penalties and interest, but this is only on system errors generated by the electronic tax system. So if it probably generates 2 penalties, or there's an error that is system generated, or an obligation in which that you are added to that should not have been applicable, then what would happen is the commissioner did not have powers to waive penalties and interest on that, and so the finance bill proposes to give these powers to the commissioner. Another provision, and this is the final one on the TPA, was the repeal of the timelines on objections and appeals. Yeah. So in the tax procedures, the Amendment Act of last year, what happened is on the time in which you're required to appeal to either an objection decision or a decision of the TAT or the decision of the High Court, in calculating the days that were given. So we're talking about 30 days. What to do is the taxpayer would actually exclude Saturdays, Sundays, and public holidays in completing the timelines. And so what this means is that the taxpayers were given a bit more time, because if you exclude the Saturdays and Sundays, there would be a bit more time for taxpayers to be able to provide their objections. So we see the finance bill again sort of clawing back on this exclusion of Saturdays and Sundays, and what really shocks us on how fair this is the same commissioner is extending time from their end to be able to know. So, for example, determine what your refund is. They add themselves time, and when it comes to the taxpayer, they seem to want to reduce the number of days when it comes to lodging objections. So that is one thing, that if the timelines go back, then it will be important to note that Saturdays, Sundays, and public holidays will actually count when it comes to objections to the commissioner's objection decision, the TAT, and the High Court. Quickly, I'll take us through the Miscellaneous Fees and Levies Act, the changes proposed by the Finance Bill. And this was actually the main change, and it deals with all goods and parts thereof of Chapter 88. So this talks about aircraft, spacecrafts, and the gliders and the balloons and all that manners. So what the Finance Bill proposes to do is it sort of shrinks these exemptions for IDF, and now it will not apply to all goods and parts of Chapter 88. And the aircraft spare parts, they have now just reduced it to all parts of Chapter 88. So you see, before it was all goods and parts of Chapter 88, but now what it specifies is all parts of Chapter 88. And when it comes to goods, it only captures two of them. And this is the aircraft of a laden weight of between 2,000 kilograms and 15,000 kilograms. And the second one is aircraft that exceeds the 15,000 kilograms. So for medium and the large aircraft, they actually exempt from IDF, RDL. But now when it comes to the small aircraft, we will actually see IDF and RDL being applicable to such imports. The other change was a reduction of export and investment promotion levy on certain goods. This was actually introduced by Finance Bill 2023. And what the Finance Bill 2025 is actually proposing to reduce the rates for some of these goods. Now it will go down from 17.5% to actually 5% for the goods that are listed there. So we have iron and steel, we have bars and rods of iron and bars of non-alloy steel and that are given of those specific tariff numbers. So without further ado, I'll hand it over to my colleague James to give us the proposed changes from a value-added tax perspective. Thank you very much.
Thank you, Kenneth, as well as Kevin for those elaborate explanations of the proposed changes from an income tax, tax procedures, as well as a miscellaneous fees perspective. So I will quickly take us through the proposed amendments for VAT and excise duty. And you'll notice that like what always happens when it comes to VAT amendments or proposed amendments, the focus is normally on reclassifications of the VAT status of different items, and that one we'll see in the next couple of slides. But then just to look at the other amendments from a value-added tax perspective that have been proposed. The first issue is just to introduce a definition of a tax invoice. This is more of sort of an administrative issue to make sure that whatever is provided for under Section 23A of the Tax Procedures Act on matters pertaining to electronic tax invoices, the same has been harmonized in terms of the requirements of what a tax invoice should be from a value-added tax perspective. And you'll notice this issue of electronic tax invoices has become very critical, especially in this period where for you to file a VAT return, remember you have to use the auto-populated VAT return. And you see the auto-population of the VAT returns is basically guided by the real-time transmission of invoices on e-TIMS. And then you'll realize that a lot of taxpayers have actually faced challenges in terms of either having erroneous transmission of these invoices, where you find when it comes to sales, you have an auto-populated return that has miscategorized the supply, either between supplies that are standard rated at 16%, zero rated or exempt. And when it comes to an input tax perspective, one can only be able to claim input that was actually transmitted through e-TIMS. And you see that's one of the issues that Ken alluded to, the fact that there are those downtimes that are experienced on the electronic tax system, which force either a late filing of a return or an erroneous filing of return, and that attracts penalties and interest. That's why there is a consideration of waiving these penalties and interest in case of any system related errors. The second issue is basically a focus, and you'll notice that even from the other presentations and from amendments that have taken place over the last couple of years, there's actually a lot of focus on the taxation of digital economy. And if you look at even the wordings that are being proposed in this finance bill, there is a lot of effort to make sure that anything that is provided over the internet or an electronic network then is subject to tax in one form or another, whether it's VAT, whether it's income tax, when we come to the issue of significant economic presence tax that replaced DST, as well as from an excise duty perspective. So when we look at the place of supply provisions in the VAT Act, the proposal is to make sure that this is expanded to include any internet services that are provided to a user in Kenya. So if you look at that scope, really, they're just trying to net on any available services that are provided over the internet or electronically to make sure that there is compliance with VAT. Then there are cleanup proposals with regards to withholding VAT. Remember, anyone who has excess input VAT as a result of making zero-rated supplies or as a result of withholding VAT is actually entitled to claim a refund. So the provisions pertaining to section 17.5, there's just a cleanup to make sure that there is alignment with the qualification for the VAT refunds, particularly pertaining to withholding VAT credits. Now, for those of us who have bad debts, and remember, bad debts will arise where you've actually made a supply, but you've not received the payment. But then remember, as the supplier, you actually required basically by the 20th of the subsequent month to make sure you do the declaration. So it happens that in those instances where you have bad debts, you basically have to make sure that you account for the output despite not having received the payment from your customers. So we have VAT refund provisions that allow for the claiming of the output VAT that has been paid on bad debts. And the criteria is normally currently that the output VAT on the bad debts will be considered after a period of 3 years from the date when you made the supply. But in terms of making the refund application, you have up to 10 years to make sure that you've actually lodged your application. So what the proposal in the bill wants to sort of address is to actually shorten that 3-year period from the date of supply to 2 years, which I think is a good, it's a good provision for those of us who want to recoup any output VAT resulting from bad debt. So it's actually shortening that period from 3 years to 2 years from the date of supply in terms of meeting those conditions. Then there is a proposal to make sure that it is mandatory to actually issue a tax invoice by a VAT registered person on any supply. I think this just emphasizes the issue of ITIMs having to generate ITIMs invoices. And maybe if I can clarify, you'll notice that even for VAT non-registered persons, they are still required to generate ITIMs invoices. Remember, this issue of ITIMs invoices does not only have a VAT bearing in terms of making sure that there is proper declaration for VAT. It also has an income tax implication where if you cannot support your expenses with ITIMs invoices, then you cannot be able to claim those expenses for income tax purposes, obviously with an exception of those kinds of payments like emoluments, imports, investment allowances, interest that are excluded from ITIMs requirements.
Now, a very interesting proposal is the imposition of VAT on the misuse of either zero-rated or VAT exempt supplies. And you see, the question really has been, if you look at the way the VAT Act is structured, you'll notice that there are two schedules to that VAT Act. The first schedule, which contains a list of all the items, whether goods or services, that are VAT exempt. Then you have the second schedule that has a list of goods as well as certain services that are zero rated for VAT. Now, remember, when we talk of zero rating and exemption status, it works in two fronts. Remember, if you are in a particular line of business and you have to make purchases, if those items you're dealing with are listed either in the first schedule as exempt or the second schedule as zero rated, it basically means at the point of purchase, you will not have any VAT to pay. But then it equally also means at the point of making the supply of those particular items, then you will still accord those items that VAT status of either zero rating or exempting. Now, what they're proposing is that if the commissioner is of the view that you have misused the items that either have a zero rating or a VAT exempt status, you will actually be required to account for output VAT at the standard rate of 16%. But then the question is, what is this threshold, or how will the commissioner go about ascertaining that there has been misuse of either a VAT exempt or a VAT zero rated item? Now, for those who supply to official aid funded projects, you know that official aid funded projects are VAT exempt. However, what has been there is that any such goods that then are supplied, excluding motor vehicles, will have that VAT exempt status. So this proposal is actually just aligning to say that any fuel, any lubricants or tires, obviously those are related to the motor vehicles that are not subject to the VAT exemption, if supplied to an official aid funded projects, will equally be subject to VAT at the standard rate of 16%. Then I think a good proposal, but then I think in the fullness of time, the benefit of this proposal of exempting tea and coffee packaging materials will be realized. Remember, I think tea and coffee is an important part of the Kenyan economy, and any tax savings from a VAT perspective would be welcome. The assumption on this proposal is by exempting these tea and coffee packaging materials, then it would mean that there will be no VAT equally at the point of purchasing these materials. So it might result in a saving. And even as I move to the next slide, maybe just to expound what the impact of zero rating and exempting means, it's basically, if you are dealing with zero rated items, you are entitled to claim any input VAT that you've incurred on your purchases. If you're dealing with VAT exempt items, then it basically means you'll have to absorb the input VAT that you've incurred on any purchases, which would mean that VAT exemption does not necessarily result in reduction in price because of the absorbed input VAT cost. But then that argument could also be extended to mean that if you are looking at a particular type of business that is heavily reliant on inputs that equally have VAT exemption, then there could be sort of a realization in terms of the reduction in cost. Now, as I started, I mentioned that there's always this categorization between the VAT status from standard rated, zero rated to exempt and vice versa. The slide that we are looking at, these are the particular goods that are proposed to be reclassified from VAT exempt to the general rate of VAT of 16%. And the first item in the list, we have food supplements. We also have medicaments for retail sale containing alkaloids. Then Ken mentioned something on the proposed repeal of the RDL and IDF fees pertaining to aircraft and parts. This is a similar proposal in the VAT Act, where basically aircrafts and parts of Chapter 88 are proposed to be made vatable at the standard rate of 16%, and basically to do away with the exemption. So I think that particular sector, as the aviation sector, will have an impact in terms of the deletion of these exemptions. And this sort of speaks to the whole reasoning or rationale of this finance bill, is to actually deal with a lot of tax expenditure in the form of exemptions and certain particular incentives. A very interesting one, touching on the tourism sector. There's actually a proposal that any goods that are used in the construction of approved tourism facilities equally will be standard rated, and an extension of that also is on the motor vehicles, the specially designed tourist vehicles. That also there is a proposal to move them, but then we'll see that in the next slide, on those items that are currently zero rated, that are proposed to be moved to VAT exempt status. Then we also have any goods that are imported or purchased locally for the direct use in the construction of affordable housing. Those are also proposed to be subject to VAT at 16%. Something touching on the extractive sector, where we have goods for geothermal, for mining activities, prospecting and exploration as well. There's a proposal to actually subject them to VAT. For those of us who deal with a lot of supplies relating to renewable energy, so that is solar and wind, currently those specialized equipment for solar and wind energy are VAT exempt, subject to seeking approvals from the commissioner. There's a proposal to make these vatable at the standard rate of 16%. Then we also have other items like discs, tapes, solid state non-volatile storage devices, weighing machinery that are purchased by hospitals, then any inputs and raw materials that are used in the manufacture of passenger motor vehicles are also proposed to be VAT exempt. Then we also have any locally manufactured passenger vehicles that are currently VAT exempt. There's a proposal to make these vatable at the standard rate of 16%. Now, this particular slide proposes to basically move some items that are currently zero rated to VAT exempt. And I believe I've explained the impact of the zero rating and exemption. So currently, if you look at the list, you have inputs or raw materials supplied to pharmaceutical manufacturers of medicaments. There's a proposal to exempt. There's also a proposal to exempt input or raw materials for the manufacture of animal feeds. And you can imagine what the cascading effect that might have when it comes to the price of animal feeds. There's also a proposal to exempt the transportation of sugarcane from basically the farms to the milling factories. Then any supply of locally assembled and manufactured mobile phones, there's a proposal to exempt them. And maybe if I can just touch on that so that you can understand the impact. We have so many companies that are doing local assembly and manufacture of mobile phones. And what these companies have actually been suffering from is from huge accumulated VAT refunds that run in billions. And it's actually taking long for these refunds to be paid. And then the question is it more beneficial to basically zero rate or exempt? But then if you look at this particular wording, it talks of supply of locally assembled and manufactured mobile phones, but it's not addressing the issue of the huge input VAT that these manufacturers have to incur when they are purchasing the parts that are used to actually assemble these phones locally. Then on e-mobility matters, there seems to be sort of a change in tact, despite the fact that globally e-mobility appears to be the future. And there's actually a proposal to basically make any supply of motorcycles with electric motor, any supply of electric bicycles, and supply of electric buses as well, subject basically from zero rating to VAT exempt. And I think the full realization of these proposals will only be seen to the extent of the inputs that are actually required to make these e-mobility products. The supply of solar as well as lithium batteries that are currently zero rated are also proposed to be exempt from VAT. Now, if we move to the excise duty proposals, similar to the VAT, what normally happens is just to make sure that there is a full realization of the scope for either goods or services that are subject to excise duty. I think for those of us in the digital lending space, this definition of a digital lender was brought in through the Tax Laws Amendment Act, just to clarify the sort of categories of businesses involved in lending activities, what they entail. So there is the first category of what we call financial institutions. And basically financial institutions are institutions that are either licensed under the Banking Act, under the Central Bank of Kenya Act. Then we also have this other form of lenders that forms a wide chunk of the industry. And basically digital lenders are lenders who provide credit through any digital channel. So basically this definition was brought in to make sure that it is very clear, to make sure that one determines if they fall under the financial institution bit that is basically licensed under the respective acts, or if you're a digital lender, then you make sure you comply with the Central Bank of Kenya Digital Credit Providers Regulations of 2022. Now, the issue of non-residents providing excisable services has also been captured and was previously captured in the Tax Laws Amendment Act of 2024. But just a clarity that basically excisable services that are provided by this non-resident of our digital platform has been extended to make sure that anything that is provided by a non-resident, that is an excisable service, that is provided over the internet or any form of electronic network or a digital marketplace is captured. So it's just to widen that scope, and that is related to the last bullet on that slide. Just to clarify that a digital marketplace is basically any online platform which brings a buyer and a seller of goods. If we look at the other proposals from an excise duty point of view, is basically a proposed stipulation of the timeline within which basically the excise license should be issued by the commissioner. There's also a proposal to basically repeal excise duty on those particular products. So imported eggs of that tariff, imported onions of tariff 0703, as well as imported potatoes, potato crisps, and potato chips of heading 0701. So if we look at now the other proposed changes in excise duty rates, you'll notice that on this particular slide, I might not want necessarily to read each and every item, but what you will distinctly notice is the change of the base upon which excise duty will be computed. For example, for the first item on imported float glass, the current rate is actually 35% of the customs value, or 200 shillings per kg. But now if you look at whatever they're proposing to be the base is the excisable value. And remember, the excisable value is the value after you've considered all customs, basically any import duties that have been paid. So you can see that that is a lifting of the base upon which excise duty is to be computed. The other proposed amendments as you move down, yes, it's a percentage, what we normally call an ad valorem rate. But then in terms of looking at these particular items based on their weight, there's a proposal to increase. For example, for the third item is a proposal to increase from, basically if you look at it from a weight perspective, from 150 shillings per kg to 200 shillings per kg. So largely that sort of forms the view, if you look at the last item, which is imported printed polymers of ethylene, currently excise duty is not applicable, but there's a proposal to introduce excise duty at the rate of 25% of the excisable value of 200 shillings per kg. And the same goes to this other slide where we have these items that are listed that currently are not excisable, but there's a proposal to introduce excise duty on these items. So that brings us to the end of the presentations, basically as contained in the Finance Bill 2025. And at this point, we would actually now want to move to the Q&A session. And basically the Q&A session is contains a number of questions that have been raised by the attendees, and which the team here will seek to give responses. And the very first question, I will direct it to Kevin Chege, and it's on this issue of the tax losses. Remember, Kevin took us through and indicated that there's a proposal to actually put a 5-year period within which you can claim tax losses. And the question goes as such, Kevin. Are there transitional provisions for the expiry of tax losses? How will entities that have significant losses from 2024 and earlier use these up, especially when they arise from capital allowances and other investment allowance incentives?
Okay, thank you, James, and for that good presentation, and for the question on tax losses. As we mentioned earlier on, is drafted in the Finance Bill 2025. The bill proposes to cap the carry forward of tax losses to 5 years. Unfortunately, the bill does not give the details as to how the transitional period will be, and for persons who have had tax losses from prior years, how that will be taken into account. And what we mentioned earlier on is that when we had such a provision introduced in the earlier years, remember we had the tax losses capped at 10 years until they were made to be carried forward indefinitely. There was sort of a transition period that provided that if you had accumulated tax losses from prior years, that year the Act changed the law to provide for a capping of the tax losses becomes your first year of carrying forward those losses. So that is missing in the Finance Bill 2025, and we expect, or will be, as much as we are going to fight against the introduction of that provision, we'll also be calling the National Assembly or the Committee for Finance and the for Finance of the National Assembly to provide clarity in the unlikely event that provision becomes law. Now, as mentioned, that provision is quite punitive because it is sort of discourages persons from undertaking capital investments. Remember, capital investments enjoy deduction and notable deductions in the Income Tax Act through the second schedule of the Income Tax Act. And there needs to be guidance of perhaps if the provision becomes law, what would become of losses that are arising from capital investment. Maybe that's a proposal we need to be pushing forward, that there needs to be an exemption in case you have losses that are arising from capital deductions to be exempted from the carry forward of the capping of the carry forward of the tax losses, because that's a proposal whose implications will be dire in the country. It will discourage people from making investments, and we always say that such proposals also encourage people to become creative in terms of their accounting and their taxes to ensure that they are not caught that net. So I think in the bigger scale of things, that's a proposal that is ill-timed because losses are genuine persons with losses. Those are normal in business operations, and trying to cap that carry forward of tax losses is not prudent in terms of operations of businesses.
Thank you, Kevin, for that. And I think the biggest takeaway from Kevin's response is the issue basically of so it's the end of 2024 year of income. You had X number of losses at that particular point in time. More or less, what we have seen happening, even when this particular provision has been amended, we've seen that you'll actually take those accumulated losses and take that as year one. Then you have to keep track until year 5. And if you have any unutilized losses from basically year 1, then and after a period of 5 years, then it means you unfortunately have to let them go. And that obviously has potentially could have an income tax implication to businesses. Now, second question, I'll throw it back to you, Kevin, because you took us through the proposal to actually repeal the 100% and potentially the 150% investment allowances. And the question goes, please explain how the changes to investment allowances will be applied for investments commissioned in 2025. Will this be based on the full year of income or specific assets commissioning dates? And maybe just before Kevin takes that question, just to clarify, in terms of the effective dates, with an exception of the proposal to introduce advanced pricing agreements that will be applicable for transfer pricing purpose, and the waiving of penalties and interest that result from an error in the electronic tax invoice, all the other proposals that we've gone through will actually be effective from 1st July 2025. So Kevin, in terms of that change and a repeal, assuming it comes into force 1st of July 2025, what will it mean to that person who had made an investment in 2025? Will they be eligible to the 100% investment allowance, for example, or what would that mean at the end of 2025 when they're preparing their financial statements?
Thank you, James, and the attendees for those good questions. But before I even attend to that question, just an addition on the issue of tax losses, because obviously it's an emotive issue, is that we have seen through the finance bill, there's also a proposal to repeal the provision that provided that you can approach the commissioner at the expiry of the 5 years or previously the 10 years for the commissioner to grant you an extended period of carrying forward the tax losses. So with the repeal of that provision, it means that there will be no such leeway for taxpayers to engage the commissioner at the end of the 5 years in terms of having an extended period to carry forward the tax losses. Coming back to the question about the repeal of the preferential rates on investment allowances at 100% and 150%. The straight answer to it is that as currently worded in the finance bill, it does not provide for what we call transitional clauses. And for those who have interacted with investment allowances, you know that the year of claiming those investment allowances becomes the year of past use. And the year of past use may be subsequent to a number of years of capital investment. If you are looking at setting up maybe a factory in an SEZ, or you're setting up a manufacturing plant outside the counties of Mombasa and Nairobi, it comes after a period of investment, maybe spanning several years. Unfortunately, as worded, the bill does not provide for transition clauses. And as we know, when the bill becomes an act, as James has mentioned, for such a provision to become law from the 1st of July, then that will be, if your year of first use unfortunately falls after 1st of July 2025, then you'll have to apply the current investment allowances at the rate of 50% and 25% for the subsequent 2 years. I think that observation and that question is really a wake-up call, and it forms part of what we'll be forwarding to the Finance and National Planning Committee in terms of our submissions, because these are some of the things that need to be reconsidered, that as much as we are coming to change such a provision, we need to provide for what we call a transitional process for persons who had already started making investments, knowing that they were meant to enjoy such incentives when they were making such decisions. And again, maybe to stretch it further, we are seeing a deliberate effort by the government to go against the provisions of what we call the national tax policy. The national tax policy provided for certainty in terms of tax policy measures, and provided that tax policy measures need to have a certain period of time before they are amended. And principally, it boils down to what we are talking about. Someone makes an investment decision, maybe to set up in an SEZ or to make an investment outside the counties of Nairobi and Mombasa, knowing that in their projections they were to enjoy an investment allowance of 100% or maybe 150%. Then along the way there is a sudden change in the law. So those are the items we are saying that because the national tax policy has already been passed to guide in terms of changes of tax laws, we need to abide with the provisions of the national tax policy so that we don't end up discouraging investors in the country.
Thank you, Kevin. So I think from those responses, I potentially foresee a situation where come the end of the 2025 year of income, investment allowances will more or less be claimed on the lower rates. For example, for manufacturing, 50% in the first year and 25% on equal installment basis. So I think that's fine. Then Ken, a question for you. If a taxpayer fails to withhold tax, but the recipient is a Kenyan entity that has anyway paid the taxes due, will they still have a liability?
Very good. Thanks for the question. Currently, as the finance bill is trying to, what it is trying to do is put a nexus, and really it is trying to understand that it is one and the same tax. So by the fact that if I have not deducted when paying it to the principal, then the principal actually goes ahead and declares a tax in their income tax return. So that provision that is being introduced, that is actually what it is intended to do. It is intended such that if the person who you are making the payment to has already declared the tax, filed his return and paid whatever balance of tax and installments, then you're sort of off the hook in that case. Yeah, so that is what the finance bill is trying to achieve.
Thanks, Ken. And I think that for the longest time has been the argument. Why penalize someone for not withholding tax, yet the supplier has actually declared the same income and paid taxes on the same? Just an additional question for you, Ken. Interest earned by an individual from a company formal commercial paper that is listed is 15%. Withholding tax, final tax, is the withholding tax final tax in this case. So it's the issue of, I think what we've been discussing about qualifying dividends and qualifying interest. What is really the position as to the 15% withholding tax? Is it a final tax, or these individuals will still be required to top up the differential of 15% on any qualifying dividends or qualifying interest?
Okay, very good. Thank you for that question. I think when it comes to interest, it is very clear because it's on qualifying interest, and that is what is paid to an individual. So when it comes to a non-resident, unless they have created a permanent establishment in the country, then in that case, it will end up being a final tax. But if they do have a permanent establishment, then in such a case, it may not be the final tax. And I think for qualifying dividends, the same actually applies. So it is a final tax for the qualifying dividends.
Thank you, Ken, for that response. The other question is pertaining on a clarification on a bad debt for VAT. And the question basically goes, it takes longer than 2 years to get a position of a formal dispute, and then the court takes a lot of time to determine the matter. Basically, how will the 2-year limit apply effectively? Yeah, so maybe just to clarify on that, the Finance Act 2023, in as much as it extended the time within which you can apply for a VAT refund resulting from bad debt to 10 years, there was also a loosening of the criteria for determining if the customer is insolvent, because you see the bad debt in many cases arose from instances where the customers are not in a position to pay. And previously, the threshold was a bit high, because if you look at the proceedings that take place when it comes to administration, receiverships, as well as the determination of a person's insolvency, those processes take a very long period of time. So basically, the reducing of this 2-year period from date of supply that now opens the window to make the application for the refund on bad debts is a reprieve, in the sense that you have a shorter period to do it. But then remember, the Finance Act 2023 also made it a little bit easier in the sense that, provided that particular customer is under administration, that by itself sort of allows you to go ahead and pursue the refund without having necessarily to wait for the formal court proceedings on insolvency to be attained. So yes, the 2-year period will be a beneficial issue when it comes to making these refunds, because then you have a shorter period from date of supply to make sure that you lodge the claim. But then remember, I think the critical thing that the commissioner always checks for is the inability of the customer to pay. And the law is very clear and addresses that particular issue by saying that, provided the customer is under administration, it doesn't necessarily have to wait until the full processes of insolvency. Then that you can actually proceed and basically make the refund application on bad debts. Maybe a question for you, Kevin. You touched on something pertaining to capital gains tax exemptions and the issue of transfer of assets to a company that is owned by a spouse or the family. Maybe you can just clarify on that definition of a family company, and if it is only limited to the fact that the company must only be held by spouses.
Okay, thank you for that question. I'll take it from this perspective. Currently, the 8th schedule provides that there is an exemption for transfer of property to a company that is owned 100% by spouses or by spouses and individual family members. And individual family members in this case means children of the spouses. Now, looking keenly at that exemption, it provides that that company is either owned 100% by spouses, so it has to be owned by more than one person. And the next provision, it provides that it is a spouse and immediate family members. So it creates a condition that that company has to be owned by either spouse and the children. And I know this is one of those submissions we've already made to Parliament before, that as much as this provision that they are brought in is welcome, because it opens up that a company can be owned 100% by one spouse for it to qualify for CGT exemption. We also need them to open up a scenario where the company can be owned 100% by immediate family members without a spouse. So that opens up a scenario where a company that is owned 100% by the children only without one of the spouses also qualifies for CGT exemption.
Thank you, Kevin. Ken, what are your expectations of the proposed changes that we've gone through? And what do we expect to see between the bill and the act? And do you expect any significant lobbying to take place?
Thank you for the question. I think as we have seen in the previous finance bills, there is always usually a lot of scope, especially due to public participation. And once public participation has gone on, it gives time for the recommendations to either be heard or not, or be rejected. And what we've seen, unless the recommendations you make actually have a very huge impact on the industry, we see that actually we would expect to see more changes rather than less changes as we go on to the second and to the third reading. So I think at this point, we still do have some time for there to be public participation. And based on our previous experience, we have seen that actually provisions do come in after the public participation. So we do expect there to be changes before the actual act comes into play at the end of June 2025.
Thank you, Ken. Do you think there is any specific mention or encouragement in this Finance Bill 2025 regarding quicker processing of VAT refunds? Given that we are seeing an extension of timelines from 90 days to 120 days before ascertainment of the refunds, the extension from 120 days to 180 days when it comes to basically the verification process in case of an audit, in case the refund has to be audited. Do you think there is anything to encourage those of us in attendance who have huge VAT refunds with KRA?
That's a very good question and a very actually a hot topic, because when it comes to the provisions that we've seen that they are changing, comes to the actual approval process. And what we realize, the biggest headache actually comes in the payment, yeah? And so even if we know that we were to shorten down the period from 90 days to 30 days or 60 days, we know the process, how it goes, that you actually have to wait for there to be funds available to make a payment back for the refund. So I think it is just more headache for taxpayers coming, because now it is going to take them longer to actually approve. And by the time they approve, then you have to wait longer for there to actually, the funds to be available to pay you back as a taxpayer. So it is actually, it's more paying for the taxpayer if you look at those provisions.
Okay, thank you, Ken. Maybe not so positive news, but then I guess we have to deal with the situation as it is. So that brings us to the end of the Q&A session. And at this particular moment, I would really want to thank all, basically all persons who've been able to attend today's webinar. I know we don't take it for granted that you've been able to spare an hour and a half, 2 hours of your time just to listen to basically our presentations on the Finance Bill 2025. And this is something we always do and we will continue doing. And even as the Finance Bill 2025 is undergoing public participation, and even up to that particular point in time, by the 30th of June, when we get the Finance Act 2025, we will obviously keep you abreast of any of the amendments that have sailed through, and also highlight any other amendments that could be made after the public participation has taken place. And just to sort of give a good recap of today's presentations, we will be sharing our tax alert after this, so that you can have further details of the proposed amendments. And I reserve a special thanks to the PKF team that has really facilitated this process. We have the tax partner, Mr. Michael Burugu, We also have Kevin Cheke, as well as Kenneth, for clearly articulating the proposals in the Finance Bill of 2025. I cannot also overlook the support team at PKF. I believe that all the attendees can attest to the technology that has actually been used to make sure that this webinar is successful. Special thanks to Brian, our marketing expert in PKF, Ragav and Aman for making sure the systems work perfectly. And I take this opportunity again to thank you, all the attendees, on behalf of the PKF fraternity and the partnership. And we look forward to future engagements on these matters pertaining to the Finance Bill, Finance Act, and any other tax changes or topical issues that would arise in due course. So thank you for your time and have a lovely day, as well as